Hello, ladies and gentlemen, and welcome to our interview with Laura Kornhauser. Laura is CEO and co-founder at Stratyfy, an award-winning developer of transparent machine learning solutions that mitigate risk and abate bias. Laura and her team at Stratyfy are on a mission to accelerate financial inclusion by providing greater transparency and less bias to critical financial decisions that impact millions of people. So, Laura, welcome to our Risk Management Show podcast today.
Thank you so much, Boris. Appreciate you having me.
Absolutely. It's my pleasure. So, Laura, I believe that we will have a very thoughtful conversation on the topic of practical applications of AI, ML in lending. But before that, could you please let us a short story about yourself, your career path, and what brought you to where you are right now at Stratyfy, and what you guys up to this day?
Wonderful. Thank you so much, Boris. So a little bit about myself. I am an engineer by training way back when, and then went to go work in financial services right out of college. And then I spent the next 12 years at JP Morgan in both lending and risk roles. Had a wonderful career. I often joke that was my career 1.0 at JP Morgan Chase. And during my time there, saw a wide variety of things, Boris, that we can get into that led to my decision to ultimately resign in pursuit of my entrepreneurial hopes and dreams. I come from a family of entrepreneurs. My parents started a business around the time that I was born, and then built and grew that business for the subsequent 3 decades before eventually selling it to a strategic. So while my first job out of undergrad was with JP Morgan, I often joke that my many first jobs were at my parents' company, everything from answering the phones when I was in high school all the way through network editing when I was in college. So I'd always had this spark or this hope and dream. And then a few of the experiences that I had while I was at JP Morgan, most notably around us trying to get the right technology to comply with the changing regulatory environment. In particular, at the time, Dodd-Frank led me to the realization that there was a lot of opportunity at the intersection of finance technology and regulated use cases for new approaches to solving these problems. So I decided to leave, went back to business school at Columbia, really was focused on testing this hypothesis that I was ready to make such a big change from a very large company to a very, very small one.
Exactly.
Got enough data points back that I was comfortable with that switch. And then while I was at school, I received multiple offers for a credit card, actually, interestingly, a credit card from Chase. And it had a great points structure. And I love a good point structure on that credit card. And I applied and I was rejected.
Oh.
And that was surprising to me. I wasn't necessarily expecting that. One, I had been heavily marketed the product. Two, I had a good credit score and I thought a good credit profile. But because I was a full-time student, I had a lack of current income and in a W-2 sense. And that's ultimately why I was rejected for that credit card product, as I later found out. And that experience for me really opened my eyes to the inefficiencies in the ways in which credit is evaluated. And when I say inefficiencies, I mean there are large segments of our population here in the US, though this happens globally, that are just fundamentally left out of the cold. Everybody says no to them. They fall outside of the buy box of every lending institution, and then are left with only predatory alternatives that further worsen or weaken their financial position, and then in some ways become a self-fulfilling prophecy from what was initially, if you will, not offered to them. And that was something I grew very passionate about and really wanted to try to address and solve. I was fortunate to around that time also meet my co-founder, Dmitry Lesnik, who had built for the prior decade a really innovative technology that is still at the heart of our solutions that I'm sure Boris will get into much more. I saw how this technology could help with this problem I had just experienced and grew so passionate about, and could really help drive greater financial inclusion for individuals, but also help FIs better manage and mitigate risks. So we believe strongly we can't do one, drive greater financial inclusion without doing the second of helping manage and mitigate those risks. So that's what led to us starting Stratyfy now 6.5 years ago, which is amazing to think about. Yeah, so we started the company in May of 2017. So soon we'll be coming to our lucky 7-year anniversary.
Oh, fantastic. Yeah. So you are from a family of entrepreneurs. You are running your own company in your young age. So I'm kind of very envious because I started my entrepreneurial career, I think, in the 50s or something. And before that, I was kind of also in big institutions like banks and consulting companies. So it's better to start early.
Well, you deserve just as much credit, if not more, Boris, because it's often harder to start later. But all of the value that you have to bring is so great from the experience you had prior.
Yeah. Okay. Let's get back to our interview. So let's do some background. Can you provide an overview of how smaller banks, particularly community banks, can benefit from integrating AI and machine learning into their lending processes? Because what opportunity does this present for institutions that traditionally rely on only traditional credit data?
Absolutely. So the opportunity that AI has to bring into the lending space is vast, but with that opportunity comes risks, right? So the opportunities, we'll start there, and then we can talk a little bit about the risks for us. But the opportunities, one, there are a number of opportunities to streamline efficiencies throughout the lending process for an applicant. So think about document collection, data extraction from those documents. So think about bank statements and other documents that provide the view into the financial health of the individual or the business. There's a lot of value that AI can provide from an efficiency standpoint. Then we get to the how do you evaluate the risk of the potential loan? That's where AI, and particularly machine learning, has a lot of value to offer. But only if that machine learning comes with enough visibility or transparency such that the lender can gain comfort in understanding what the machine learning is doing. So this is a place where black box machine learning solutions simply do not work. And you need to understand how that machine learning solution is helping you ultimately predict the riskiness of an individual or a business. This is the space where we play in Stratyfy, where we're helping lenders understand the true risk of potential borrowers and then make more informed decisions about how to interact with them. That's everything from pre-qualifications through underwriting, through behaviors after a loan has been dispersed. We're helping with all of those risk-based predictions and decisions off of those predictions. Then there's a number of opportunities after a loan has closed, also for AI to help enhance efficiencies and customer experience. So, there are use cases within natural language processing using chatbots that can be really valuable once you, both in bringing the customer in door and after the customer's been onboarded, that again help drive efficiencies. But everything I was talking about earlier in that credit risk assessment and decisioning process, not only has the ability to drive efficiencies, but also has the ability to drive top and bottom line impact. So finding places where you can extend more capital and give more loans without increasing your expected default rate, managing risk through different market cycles and understanding how your portfolio dynamics will change. Machine learning has a ton of value to offer in all of those risk-based, I'll say, challenges or problems that not just help with efficiency and scalability, but also can help with revenue generation and profitability.
Mm-hmm. And how about human expertise? For example, you mentioned the importance of pairing AI and expertise, human. How can this marriage of these science tools with subject matter experts enhance the lending process? And why is the combination crucial in this context of AI in London?
Thank you so much for that question. I absolutely agree that it's completely crucial to have this combination of AI or machine learning with human expertise or context. So machine learning is really good at extracting insights from data. Humans are really good at providing the context around data or the context around those insights. And at Stratyfy, what we do for our customers is enable them to combine those two into one still scalable, still automated model for predicting and decisioning, but a model that has benefited from both insights from data and insights from humans or subject matter experts. This is so essential, especially in lending, because all of the data that we're using to build these models is biased data. And it's biased in a wide variety of ways, which is part of the reason that makes these biases so challenging to address. But if you just learn from the data, or if you just put a machine learning algorithm on top of the data, you are going to learn what you were fed. That's what a machine learning algorithm does. So it will learn those same biases and then propagate those biases going forward. So that human intervention is so powerful in addressing these issues of bias, and it's also so powerful in providing, again, that context around the data, because ultimately all this data that you're using to train a machine learning model is backward looking, or it's from the past, and that human or that subject matter expert can help put the context in that makes it work in the future. So those are the reasons from, I would say, a performance and risk standpoint, that it's so important to have that human, as we call it, human in the loop, and others call it as well, as part of the machine learning for these really important and valuable use cases. The other thing that's important that is often included under this human in the loop umbrella within machine learning is that you need a model that is not a continuous learner. So it can't be changing all the time. That doesn't work in this area. It would be an absolute disaster from a model risk management standpoint, because the model today is different from tomorrow. So that's another reason that is often grouped under the human in the loop umbrella, Boris.
Fantastic.
Yeah.
Let's discuss about transparency, because in this realm of AI, machine learning, this transparent, some people may feel themselves kind of, as you mentioned in your introduction, they can get out of mainstream, like minorities and people with different backgrounds and mainstream. So what is how to maintain visibility, transparency, and in this lending sector?
Another thing that is of critical importance, Boris, one, that is partly due to laws and regulations that require, for example, lenders in the US to be able to tell borrowers why they were rejected, if they were rejected. So there's a legal requirement, if you will, that puts a push on transparency. Though I truly believe that it's deeper than that, and it's deeper than just fulfilling that legal requirement. In order to trust a model, machine learning model, or any kind of model, I believe that it's fundamental that you need to understand how it's working. If you don't know what's happening inside the black box, how can you trust it to help you make informed decisions? How can you feel confident in the predictions that it's churning out? I just believe, from almost like a fundamental or human perspective, if you don't know what's happening inside the box, you can't nor should you trust it. Now, some people, because it is well known that black box is bad, there is a lot of folks that throw around the terminology of transparency, and it can be often hard to understand what is meant when people talk about transparency. For example, some folks will say a model is transparent if you understand what went into it and you know what came out of it. I would argue that that is still not transparent enough for use cases like lending, use cases that truly impact people's lives. If you don't know what happened in the middle or in the box, it's not enough to know what went in and what came out. You still need to know how the box is working, how those predictions are being made, what factors are being looked at to make those predictions, what are the internal parameters or weighting factors that are being used to, do that tug of war between things that make someone more creditworthy and less creditworthy. It's so essential to have a full understanding of that so that you can have confidence. And I think also that transparency should allow the users, and this goes back, Boris, to your question of human in the loop. Transparency should allow the user to override what's in the model. So if I have the transparency that I need and I can see what's in the model or understand what's in the model, I should also, as the user, as the subject matter expert, I should also be able to change it, push it in this way or that way based on how I believe the data might be biased, maybe misrepresentative of what will happen in the future, maybe not aligned with the customer profiles and types that I want to address. So that's, I think, another piece of transparency that's often missed, is that, again, human in the loop element, or the ability for the human to intervene.
Awesome. So I would like to ask you a personal point of view. What is the major misconception in the field of AI and lending that you strongly disagree with?
Fantastic question. There is a belief that greater model complexity will lead to better performance. So there are certain players out there that like to talk about how their model looks at thousands of attributes and has all of this complexity and how it produces risk-based decisions and predictions. I believe strongly that the hypothetical or on paper performance increases that most of that model complexity gives do not equate to performance after deployment. And that can be for a number of reasons, Boris. It can be because the deployment process becomes too hard or too challenging with things like model risk management, because the model is overly complex and nobody can understand it. And then that also can be due to things like overfitting, only looking at the data, not addressing the bias issues in the data, not having the ability. If your model's so complex and looks at all of these different attributes in a black box way, there's no ability for the human or subject matter expert to intervene. So I think that is, for this use case, is just fundamentally not the right approach. And what we've shown through our work is that you can significantly reduce that model complexity in a good way, both from a number of inputs or variables you need, and also from the model standpoint as well. Still get very strong performance and reap massive benefits as far as transparency and control that much outweigh a hypothetical, slightly better AUC that the very complex model offers.
Interesting. So let's discuss about industry transformation and kind of a new prognosis or new trends. So what is, in your opinion, how do you see the landscape of lending evolving with the increased adoption of AI and machine learning? And what are specific trends or changes that you anticipate, especially for smaller banks and institutions?
Yeah, I'd put those major trends, especially in the short term, in two buckets. One is around data, and the other is around modeling approaches, or a sophistication around modeling and analytics. And I think that there are going to be major changes in both of those. I'll start with the second. So the traditional way of making credit decisions uses very, I'll say, sharp cuts that leave a lot of people out, or result in a lender rejecting too many good applicants. I'll give you an example, Boris. One of the lenders that we worked with when we initially started working with them, where we ran a test to evaluate their existing lending criteria. And we did it against a data set, a retro data set we got from the credit bureau. So we could see what happened to the people that they rejected. And we found that they rejected 70% of good borrowers that later repaid their loan, right? So there are very good borrowers that lenders are missing out on, and more advanced modeling techniques to predict the riskiness of a wider array of borrowers, and moving beyond heavy reliance on things like a FICO score is going to allow lenders to capture those borrowers, and also allow lenders to better manage and mitigate risk, because we're also at an interesting point in the credit life cycle where a lot of lenders are very focused on the riskiness of their portfolios. So that's one on the modeling or analytics side. Two, and then I expect that will have some follow-on impacts that allow a lender to also update models more frequently. Right now, most lenders update their models or decisioning strategies around their lending portfolios very infrequently. So I think that will also lend to changes in how these models get approved and monitored and all of these things. Two, data. We often are working with traditional credit bureau data, at least when we start working with our customers. But we're seeing an increased appetite for alternative data as part of lending, risk evaluation and lending decisions. I like to be very clear here, because when we're talking about alternative data, we're not talking about social media likes on my Facebook account, right? We're not talking about, as I like to joke, like that alternative. But we are talking about things like non-traditional income, rental payment behavior, which has been proven to be extraordinarily predictive of payment behavior on loan products. And also rental payment data has been proven to be able to have a great impact on inclusion as well, particularly with thin and no file applicants. Some folks have had some great results with utility data, mobile data, right? All of these, I would say, non-traditional, but still very relatable to the ultimate behavior you're trying to model, which is the behavior of paying back a debt. This data is going to be leveraged more widely. It's gonna show the value that it has to contribute, and that I believe will also be very meaningful in expanding access to fairly priced financial products.
All right, thank you. So let's drill a little bit deeper for practical people in the trenches, working in the trenches. So if we take a life of a risk or compliance manager who has to approve all this application, if there is one thing that they should start to prioritize right now that they are not doing, what is your opinion?
Make sure you understand how the model works to a level of detail that you would be happy with it making decisions for you, because that's ultimately what it's doing. And don't allow folks to try to hand wave through your important questions about that model, about its robustness, about its how the internal mechanics works, how it arrives at a risk prediction, how it arrives at a decision recommendation, and really go deep on that. And partners that aren't willing to go deep with you on that are not the right partners in this type of transformative journey.
All right, fantastic. So if we summarize our interview for someone who is listening to it and would like to walk away with one or two major takeaways, what would it be?
Machine learning, or AI more broadly, machine learning more specifically, has a ton of value to offer in expanding access to fairly priced financial products. With that value, there also are significant risks, particularly if you cannot fully understand how risk-based predictions or decisions are being made. That risk will expose you to financial downside, but also bias risk that can create reputational damage, can create challenges with regulatory bodies, et cetera. So in order to leverage the value that this technology has to offer, it is absolutely essential to have true transparency into not just what's going in to the model, not just what comes out of the model, but what happens in between as well.
Fantastic. So Laura, thank you very much. That's were all my questions. Perhaps if I forgot something to ask you that you think is beneficial to our audience, please go ahead.
Yeah, so one thing I would love to mention, Boris, is a partnership that we announced just a few months ago that I'm extraordinarily proud of, and I truly believe is a groundbreaking initiative that will be a roadmap for future initiatives going forward that I'd love to tell folks about quickly. It's a partnership with Beneficial State Foundation for the Underwriting for Racial Justice pilot program. In this program, we've selected 20 lenders, different types of lenders, banks, credit unions, loan funds, et cetera, that are all committed to driving greater racial equity in their loan programs, and are all committed to proactively making changes in order to drive greater financial inclusion. We are their technology partner, helping them figure out how they can make modifications to their risk-based decisioning in the loan in their loan business across different loan products, right? So we're working across different loan products here, and then each of these 20 institutions have also agreed to be part of this consortium where they come together not just only to discuss best practices, what's working, what's not, but also share insights from the performance of these incremental loans that they're making to drive greater financial inclusion. We are just getting started with this unbelievable initiative. We're going to have some really amazing impact that we drive, and also I believe strongly that this is going to showcase to the world how a lot of individuals that are left out of our financial system right now are not as risky as things like a 3-digit score would maybe indicate. And if you take the time and energy to evaluate them in a more true way, you'll see that, and you'll be able to find that, and we're going to prove that with this Underwriting for Racial Justice pilot program. So lots of information online about this program. I encourage folks to check it out. I encourage folks to reach out to us or Beneficial State Foundation directly to learn more. But it's a really exciting initiative that we're just a few months into, and I couldn't be more proud that Stratyfy is the partner too.
Absolutely. Thank you again, Laura, and I wish you and your company Stratyfy a great success in your all your new developments and partnerships.
Thank you so much, Boris. I appreciate the opportunity, and thank you everybody who listened in. Really appreciate you taking the time to be with us.
Absolutely. Thank you. Bye-bye.